Hello and welcome to this skills and training webinar entitled Understanding Finance. In this webinar, we will have a look at the most common statements of financial information that trustees will be asked to examine and understand the information contained in each. Before we start looking at any numbers, we will have a look at the legal responsibilities for trustees from a charity finance perspective. There are four, and these are: number one, the duty to ensure your charity carries out its charitable purposes. Number two, the duty to act in the best interests of the charity. Number three, the duty to manage your charity's resources responsibly. And number four, the duty to comply with your governing document and the law. So now we will have a look at some numbers. We're going to have a look at the two most common types of financial information that trustees will be asked to examine and understand, and that is, number one, statutory accounts, and number two, management accounts. As detailed on the slide, statutory accounts are prepared to an agreed format that is set out in the Companies Act and also international standards. Charities are expected to prepare their accounts as set out in the Statement of Recommended Practice, which is commonly known as the SORP, that takes the requirements of the Companies Act and adjusts them to meet the requirements of charities. We're going to look at the two main statements contained within the statutory accounts, and they are, number one, the income and expenditure account, or the profit and loss account, and number two, the balance sheet. So when we're looking at the statutory accounts, we are thinking about four questions. Number one is income covering expenditure. Number two, where does the money come from? Number three, where does the money go? And number four, is there enough for a rainy day? The first three questions will be answered by looking at the income and expenditure account, and the final one will be answered with the information in the balance sheet. Note that, in general, the income and expenditure account covers a specific period, normally 1 year, whereas the balance sheet covers when the organisation started trading to a specific point in time, which is normally the year end to match the income and expenditure account. Now we'll have a look at a statutory accounts example. We're going to look at the handout Commentary on the Model Trustees Annual Report and Accounts, Dorsetshire Drugs Advice Centre. This is the income and expenditure account for the Dorsetshire Drugs Advice Centre for the year ended 31st of March 2009. So that means that the figures cover the period from the 1st of April 2008 to the 31st of March 2009. I know that the full statement is quite small on the screen, but hopefully you will have a copy of the accounts in front of you and you're able to see the detail of the statement on page 9 of the accounts. So some points to note about the statement are, number one, the full statement is on one page. Number two, columns show the split between unrestricted and restricted funds. Number three, total columns are shown for both the current year and the previous year. Number four, figures for both income and expenditure are shown over broad categories. And number five, there is a notes column. This refers to notes which show more detail and income and expenditure analysis. So dealing with the first question, is income covering expenditure? Looking at the income and expenditure account for the year ending 31st of March 2009, we can see that the net movement in funds for the year at 2009 is 54526. Therefore, in 2009, Dorsetshire Drugs Advice Centre created a surplus of 54526, which is a positive position for the centre to be in. Comparing the figure with last year's, we can see that there was also a surplus last year, but it was higher than this year's figure. When we have a look at the income and expenditure figures in a bit more detail, we will be able to see why the surplus was lower this year. So the second question asks, where does the money come from? Looking at the top half of the income and expenditure account, we can have a look at the makeup of the total income and resources. There are 5 different categories of income which make up the total for the year of 543,330. And we can see that the total of 543,330 for the year is higher than last year's figure of 465,332, a difference of 77,998. The figure for donations and grants of 14,900 is only £1,308 more than the previous year's figure. Similarly, shop income of 34030 is only 454 less than last year, and investment income of 3330 is £682 more than last year. So none of these first 3 income categories are significantly higher or lower than last year's figures. The majority of the increase for the year is contained within the last 2 income categories, covering the organisation's income from their charitable activities. That is, income from grants and contracts, which has increased by 47,736 to 300,000. And income from the cafe and drop-in centre, which has increased by 28,726 to 191,070. In order to find out more detail about the income from charitable activities, we need to have a look at Note 3. So Note 3 shows that the funding received from Dorsetshire County Council has changed slightly, with an increase of £20,000 for the advice and information service, but a decrease of 22,264 for the outreach service. The note also shows that £50,000 was received from Dorsetshire PCT to provide a counselling service. This was a new funding stream for the year. Since this is funding for a new service, it is worth keeping in mind that there should be a subsequent increase in costs, especially in salary costs, when we look at the expenditure details. The details relating to the income from the cafe and drop-in centre are also contained within Note 3. However, all it shows is the figures that are contained within the income and expenditure statement, with the description showing income from cafe. So to summarise on the increase in total income and resources, most of the increase relates to receiving £50,000 for a new counselling service and a 28,726 increase in cafe sales. When we consider the third question, where does the money go, we are looking at the expenditure of the organisation. So referring back to the bottom part of the income and expenditure account, we can see that total resources expended has increased to 490,328 in 2009 from a figure of 394,576, an increase of 95752. If we look at the 4 expenditure categories, we can see that for 3 of them, there has not been much change from the 2008 figure. The cost of generating voluntary income have decreased by £836 to 2,950. Fundraising, trading, cost of goods sold and other costs have increased by 1,298 to 2,3748. And governance costs have increased to 2,588 to 17,332. So the majority of the increase relates to expenditure on charitable activities, which has increased by 92702 to 446,298. Note 4 contains the relevant detail we need to determine details about the increase of 92702. However, whilst there is a comparative 2008 figure, there is no split over the different expenditure categories. We can see in note 4 that there are costs relating to the other 3 expenditure categories, which are marked in the red boxes. Voluntary income totalling 2950, which all relates to support costs. Charity shop totalling 23748, which is the cost associated with fundraising training, and the governance cost totalling 17332. So that means that the other 3 categories of expenditure shown in note 4, the advice and information, outreach work, and cafe training project, make up the charitable activities expenditure. Looking at the expenditure detail, it is difficult to determine variances from last year which relate to charitable activities only. However, we can see that the first line of costs, staff costs, only relates to charitable activities, and the expenditure has increased to 369,776 in 2009 from 295,464 in 2008, an increase of 74312. Part of this may relate to the funding given to the new counselling service that we identified in the income variations. The other expenditure category, which can be attributable to charitable activities expenditure, is consultancy, which is the cost shown fourth from the bottom. There was no spend against this expenditure category last year, but there is 6,212 this year, of which £6,000 is attributable to charitable activities. Therefore, we have managed to account for around £80,000 of the 95,752 increase in expenditure, and can say that the majority of the increase relates to staff and consultancy costs. The rest of the amount relates to all other categories of expenditure, with all but 2 categories shown at an increase from last year's costs. The Advice Centre also has investments where any gain on the revaluation is shown within the income and expenditure account. In this case, the increase from last year is 1524. So when this is added to the net income and resources before other recognised gains, the result is a net movement in funds for the year to 31st of March 2009 of 54523. So, to recap, the comparison of the current year's income and expenditure account figures with last year's shows that a surplus of 54526 was generated for this year, but this was down by 16,634 on last year's surplus. On examining the information in the notes to the accounts, we can see the income increased by 77,998 on last year's figure, mainly due to an increase in grant funding of £50,000 to provide a new counselling service, and an increase in income from CAFE of 28,726. However, there was also an increase of 97,752 in expenditure, the majority of which was due to an increase in both staff and consultancy costs. The last question to consider is there enough for a rainy day? So in order to get an answer to this fourth question, we need to have a look at the balance sheet. Again, the things to note are, number 1, that the full statement is on 1 page. Number 2, total columns are shown for both the current year and the previous year. And number 3, there is a notes column which refers to notes which show more detail. If we look at the last line of figures in the balance sheet, we can see that total funds have increased from 43130 in 2008 to 97656 in 2009, an increase of 54526, which is the net movement in funds for 2009 shown in the income and expenditure account that we have just looked at. Looking at the total funds, we can see that this is split between unrestricted funds of 56792 and restricted funds of 40864. And the note reference to provide more detail on these funds is note 14. If we have a look at note 14, it shows that the restricted funds are for £7,500 for computer equipment for the counselling service, 8616 for counselling, advice and information service, and 24748 for outreach. And you can see that there is more detail within note 14 about the purposes of the restricted funds. The note also shows that unrestricted funds are for £20,000 designated fund for training project equipment, 3658 designated for the revaluation of investments, and 33134 for general funds. So although the £20,000 for the training project equipment was part of the general funds, the Advice Centre has decided to use some of the general funds and designate it specifically to spend on training project equipment. Using some of the figures in both the income and expenditure account and the balance sheet, we can work out how many months' worth of expenditure the centre has in reserve. If we take the 33134 for general funds, which is our free reserves figure, and divide it by the total expenditure figure for the year in the income and expenditure account of 490,328, and then multiply it by 12, the result shows that the Advice Centre has under 1 month's worth of running costs available in reserves, which is a good bit short of the organisation's reserves policy to have 3 to 6 months of the expenditure in reserve. This reserves policy is detailed on page 5 of the full set of accounts, with the note also stating that the Management Committee acknowledges that the target range is unlikely to be reached for at least 5 years. So that is the bottom half of the balance sheet examined. Now we will look at the top half. This shows the makeup of the total funds. The first category to look at is fixed assets, and the detail for the fixed assets is included in notes 9 and 10. Note 9 shows that the tangible assets that the Advice Centre own, in this case office equipment, is currently valued at £22,500. Note 10 shows that the investments made by the Advice Centre are currently worth 23,308. So this brings the total fixed assets to 45,808. Now looking at the current assets. So the definition for current assets are those which can be reasonably expected to be converted into cash within 1 year. And the most common current assets are stock, debtors, bank and cash. So for the Advice Centre, the stock levels are low at 334. The debtors are 15,226. And if we have a look at note 11, which gives that bit more detail in the debtors, it shows that the debtors is split between 13,084 for trade debtors, contract income receivable, and other debtors and prepayments of 2252. And now back with the list of current assets, we've also got an entry of cash at bank and in hand of 52,946, and that gives us a total current assets figure of 68,616. Within the current liabilities, there is only one figure of minus 16,768, which is for creditors. And note 12 indicates that the creditors' amount of 16,768 includes 8,916 for taxation and social security and 7,852 for other creditors and accruals. Taking the creditors' figure of 16,768 away from the current assets figure of 6,8616 results in a net current assets figure of 51,848, which is a healthy position for the Advice Centre. The current assets figure and the current liabilities figure can also be used to calculate what's known as the current ratio. This is a ratio that many funders will look at when provided with an organisation's balance sheet. To calculate the current ratio, we divide the current assets figure of 68616 by the current liabilities figure of 16,768, and the result is 4.092. This means that for every £1 owed by the Advice Centre to other organisations due within the space of a year, it is £4.09 available that it can use to cover these liabilities. So you may also see the current ratio written as 4.0921. And that's the details of the balance sheet covered. So now we're going to have a look at management accounts. So the management accounts example we're going to look at is one which compares the budget, what an organisation thinks is going to happen, to the actual, what actually happens for the period. This is the one-page handout headed Spring Hill Advisory Services Management Accounts Information 9 months to 31st of December 2019. The example covers a budget and actual comparison for a 9-month period for an organisation called Spring Hill Advisory Services and shows a variance from budget and a percentage variance. A percentage variance can prove useful as you may decide that any variance of plus or minus 5% is within an acceptable level, and there's no need to worry about that degree of difference. There is more detail on what to include in a management account statement in the handout, the Essential Charity Finance for Trustees on page 26. As well as containing the figures, the example also has a comments part where a note has been taken of the significant figures making up the variance. The example adopts the same principle as the statutory accounts, including all the information on the one page. However, this time around there is no note references. Instead, there is more detail on the income and expenditure categories and further detail within the comments section. There is also some balance sheet information contained on the statement, which covers net current assets and reserves. If this extra detail doesn't provide the answers, then the detail can be provided by the person compiling the management accounts information. If we remember back to the statutory accounts, we posed 4 questions with regard to the income and expenditure account and the balance sheet. Number 1, is income covering expenditure? Number 2, where does the money come from? Number 3, where does the money go? And number 4, is there enough for a rainy day? We can apply these same 4 questions to our management accounts information, but this time around the comparisons we'll be making will be to a set budget rather than to last year's figures. So looking at the statement, which is headed up Income and Expenditure Account 9 months to 31st of December 2019, the surplus deficit figure for the year is showing a surplus of 19,707.96 against a budgeted deficit of minus 3,393.40. So the organisation is performing much better than expected. To find out the reasons why, we have to look at the detail for both the income and the expenditure. So just something to note about the variances on the income and expenditure account. The variances are not just a straight budget less actual calculation. They are calculated to reflect the effect on Spring Hills Advisory Services' financial position. Therefore, if income is budgeted at £100,000 and the actual is £95,000, the variance is minus £5,000, a negative position for the organisation since there is less income coming in than was expected. If the variance had been calculated as a sum of budget less actual, this would have shown a positive variance of £5,000 for the organisation. And then if the figures were the same for expenditure, the variance would be a positive variance of £5,000 since there would be less spend than was anticipated. So considering the question, where does the money come from? If we look at the total income figures, we can see that the budget figure was 485,275.23, with the actual figure 527,840.26, which is 42,565.03 more than was anticipated. The individual income categories show that two types of income, membership income and earned income, were within a positive or minus 5% variance. There are comments related to these variances, but since they are within that set tolerance, we'll just look at the other three income categories, which are highlighted in yellow. The conference income was £18,929.52 greater than budgeted. The comment section show that the organisation didn't get as many practitioner members as they thought, with a shortfall of minus 2,500, but they gained 12,885.91 more from associate members and 9,657.87 more from practitioner non-members. Grant income was 19,501 greater than budgeted, and the comment section states that this was mainly due to a grant from Comic Relief for £20,000. Miscellaneous income was 9,553.64, greater than budgeted within the comment section, showing that the majority of this figure, 8,590.28, related to fundraising. So if we consider the next question, where does the money go? We can see that total expenditure for the year was 508,132.30 against a budget of 488,668.63, a variance of minus 19,463.67. Note that the variance column shows this difference as a minus variance, even although the actual total is bigger than the budgeted total. This is because, as explained, the variances are showing the impact on the organisation's bank position. Therefore, incurring more expenditure than budgeted is detrimental to the organisation. So there are 6 categories of expenditure highlighted in yellow, where the variance is greater than plus or minus 5%, with only one category below the tolerance level. So actual consultants' costs for the period are 20,484.87, a variance of minus 3484.87, and the comment section shows that the majority of the cost relates to marketing advisors with a variance of minus 2,500. The next category of costs to look at is other events costs. The figure for the period is 10,516.34, a variance of 2,016.34. The comment section shows that minus 1,650 of this variance relates to an information away day. Conference expenses for the period is 98,318.10, a variance of minus 5,718.10. The detail within the comment section show a minus variance on both hotel expenses and miscellaneous expenses of minus 66014 and minus 128611 respectively. These minus variances are offset by a positive variance of plus £2,000 for entertainment expenses. The next category of costs to examine is client costs, where the organisation only provide a small budget of £150, but actually incurred costs of £401,605, resulting in a variance of minus £3,86605. The comment section details that the variance was mainly due to client printing costs of minus £3,96605. The percentage variance for committee costs is minus 5.38%. However, the actual variance is only minus 66193, so it's not really playing a significant impact on the total expenditure variance. The last category of costs to examine is general costs. The actual figure for the period is 116,885.01 against a budget figure of 111,214.63. Looking at the comment section, the variance of minus 5,670.38 is made up of four significant variances. Two positive variances of 3,163.96 for marketing and 3,270.04 for miscellaneous expenses, and then two negative variances of minus 8,792.23 for repairs and maintenance and minus 4,414 for printing. So to recap, the comparison of budget to actual on the income and expenditure account for the 9 months to 31st of December 2019 show a surplus of 19,707.96 generated for the 9-month period, compared to a budgeted deficit of 339,340, giving the organisation a positive variance of 23,101.36. Looking at the income part of the statement, the budgeted total income was 485,275.23, and the actual total income for the period was 527,840.26, resulting in a positive variance of 42,565.03. Then looking at the expenditure details, the budgeted total expenditure was 488,668.63, and the actual total expenditure for the period was 508,132.30, resulting in a minus variance of minus 19,463.67. As we could see when we looked at each income and each expenditure variance, there were a number of different positive and negative variances that make up the total variance for the period. Since this statement is for the 9-month period to the 31st of December, it is a matter of looking at the detail for each variance and trying to figure out whether the variance will remain at a similar level at the year end, or whether the financial activity for the final 3 months of the year will reduce these variances so that the actual figures move closer to the budget. So we've looked at our income and expenditure details for the 9-month period to the 31st of December 2019, and we've considered the first 3 questions. Is income covering expenditure? Where does the money come from? And where does the money go? Now, within our management account statement, we're going to have a look at the 4th question. Is there enough for a rainy day? So looking at the net current assets, the balance sheet extract information shows that the organisation has 44,750,754.93 in total current assets and only 4434.67 in current liabilities. This means that the current ratio result is 10.09, leaving the organisation with more than enough money to cover any short-term commitments. The net current assets also shows that the organisation has 35,247.07 in cash or at the bank. And then if we look at the other side at the reserves details show that if the surplus figure of 19,707.96 in the income and expenditure account is added to the unrestricted reserves figure at the 1st of April 2019, there is an unrestricted reserves figure of 94,917.96 at the end of December 2019. If we compare this figure to the total expenditure figure of 508,132.30 in the income and expenditure account and multiply it by 12, the result shows that there are 2.24 months worth of running costs in reserve, which isn't quite the 3 to 6 months worth of running costs, which is a typical standard reserves policy. So that concludes our overview of both statutory accounts and management accounts and brings an end to this webinar.